From retail to rescale, as our producers put it, Wedbush Securities is upgrading Netflix from neutral to outperform, stating that while they don't expect the streaming giant to return to 2021 levels anytime soon, they do believe Netflix is positioned to exceed its Q2 guidance. Joining us to discuss is Michael Pachter, Wedbush equity research analyst. Michael, you got a lot of people talking with your note because you were one of the most bearish on Netflix. What changed?
Share price changed. So, the stock was overvalued in the 600s. I think it peaked at 690. It's undervalued in the 180s. And, when it dropped from 690 to 340, I upgraded to neutral last quarter. And it just kept drifting lower. And there's just a point where 220 million subscribers, represents real value. This is not a dumb management team. They're very, very smart. They have a ton of content, and they've made tens of billions of dollars of investment in content. They're spending nearly 20 billion this year. And they just have finally gotten to the point where they're ready to leverage that investment. And modest growth in revenue is going to drive big growth in profit. I think that the street heard them miss the subscriber number. They guided to plus 2.5 million and they delivered minus 200,000. And then they guided to another minus 2 million this quarter. And I think the street thinks they're going to zero. They are not. So I think that if you look at every other streaming service, they added subscribers during the quarter that Netflix lost them. So net, it was a big positive. And I think this is going to normalize. I think ultimately you're going to see streaming continue to grow because people are cutting the cord or shaving cable. And I think that Netflix is going to always be the anchor subscription. What they have to do is reduce churn, and they're taking steps to do that with their crackdown on password sharing, their introduction of an ad-supported tier, which will be lower priced. I think they need to stabilize their content spend, and they're already sounding like they're doing that. And when they start delivering leverage, the stock's, I think, going to rip right up to my $280 price target. Less than half of where it was 6 months ago, but 40% upside from here.
Yeah, and Michael, again, certainly a pretty rough ride for Netflix so far, I believe down 70% year to date. But the story for Netflix is kind of emblematic of what's been going on to other tech stocks as well. And you kind of hear this, and these stories about analysts saying, well, maybe we're shifting to more of a cash flow type of situation for these companies as opposed to the high growth that we had been seeing over, let's say, the last decade or more. So do you think that's also applicable to Netflix in such a way that maybe the net subscriber ads shouldn't be the big focus for people watching the stock in the quarters to come?
Yeah, Brian, 100%. I downgraded these guys to sell in November of 2011, and I wrote about a 20-page note talking about cash flow. Cash flow was negative every single year following until I think 2020, first year of COVID. So they burned through cash up to as much as $3 billion a year. Cash flow was a story. They were positive 1.9 billion in 2020 or 2021. They're turning negative again, flattish this year. But they're positioned to generate a ton of cash, and they're at the point where earnings is a proxy for cash. So, we're looking at them making 10, 12 bucks a year this year. And again, who knows, let's let them get through one more quarter, and 14, 15 bucks a year in a couple of years with 450 million shares. So we're talking about, generating 6, 7 billion in free cash flow. I think that's coming relatively soon. And I think when the market sees that, they're going to bid the shares up to 280.
Michael, there's been a lot of talk about how to get more subscribers on board, but I wonder what you think about just the content offering, right? At the end of the day, it is about the content on these streaming sites. And some would argue that while Netflix has really gone in on the quantity in terms of the amount they offer, the quality's kind of dropped.
Yeah, Netflix is the Taco Bell or McDonald's of video. And, HBO is the Ruth's Chris or Morton Steakhouse. So sure, you go into, to HBO expecting to get, knocked out by a handful of great shows. You go to Netflix expecting to fill your time. And, Netflix consumption is something north of 30 hours a month. So sure, it's bite-sized, but that's kind of true of broadcast television as well. People spend upwards of 80 bucks a month for broadcast TV. There's only a handful of good shows, and they spend the rest of their time, watching Fox News or something else. I think that quantity is important. And you guys are just talking about Walmart. Nobody goes into Walmart expecting to buy premium brands and spend a ton of money. They go in for quantity, and that's what Netflix is. They're the Walmart of streaming video, and they've got everything.
Michael, so what does that make YouTube then? I mean, people kind of ignore that story because they're folded under Alphabet. They're not their own standalone company, but they get a lot of subscribers, a lot of watchers, a lot of revenue for way less cost for the content itself. Are they like the
it's user generated?
I don't know. What does that make them?
I mean, the content's largely free. It's user generated content. That's a different model. So I think that that's like comparing TikTok, to a record label, to Spotify. Yes, you can entertain yourself on TikTok and listen to amateurs perform, and 1 out of 500 is going to be phenomenal. Or you can listen to your favorite artists on Spotify and pay more. So YouTube is to Netflix what TikTok is to Spotify. Sure, of course. There's room for all of this stuff. We like user-generated content. And, you get people like Justin Bieber who emerge from YouTube. That's great. But he's 1 out of 10 million people who posted music videos on YouTube who made it.
Right. Well, of course, with everything, you're always competing with only 2 eyeballs. So very much a lot of movement in the media space. Michael Pachter, Wedbush equity research analyst. Thanks again for spending time this morning. Appreciate it.